The Dhandho Investor, by Mohnish Pabrai. Introduction. Imagine for a moment that you've been forced to leave your home. Everything you've ever built, everything you own, is suddenly taken from you. You arrive in a new country, America, as a refugee in the early 1970s. You have no capital, very little education, and you can barely speak the language. The odds are stacked so heavily against you that survival, let alone success, seems like a distant dream. Now, imagine that just 35 years later, your small, impoverished community doesn't just survive, it thrives. It comes to own over half of all the motels in the entire United States, controlling over $40 billion in assets, employing nearly 1 million people, and paying over $725 million a year in taxes. How is that possible? How does a group of people, starting with absolutely nothing, achieve such extraordinary success? It wasn't through high-risk gambles or Silicon Valley-style innovation. It was through a simple, ancient, and powerful mindset. A mindset that flips the entire idea of risk and reward on its head. This is the story behind Mohnish Pabrai's modern classic, The Dhandho Investor. Pabrai, a brilliant investor in his own right, pulls back the curtain on this low-risk path to high returns. He introduces us to a Gujrati word, dhandho, which literally means endeavors that create wealth, but in practice, it's something much deeper. It's a framework for business and investing that is all about one simple, beautiful concept: heads, I win; tails, I don't lose much. Today, we're going to journey into the heart of this philosophy. We'll meet the Patel motel owners, the flamboyant Richard Branson, and the quiet steel magnate Lakshmi Mittal. We'll see how they all use the very same principles to build their fortunes. By the end of our time together, you won't just understand a new way to invest, you will have a new lens through which to see the world of business, opportunity, and wealth creation itself. You will understand how to make bets where the odds are overwhelmingly stacked in your favor. Book summary. The story of Dhandho begins with a group of people called the Patels, from a tiny region in Gujarat, India. In 1972, the dictator of Uganda, Idi Amin, expelled them from the country, seizing all their businesses and assets. Thousands of Patel families were left stateless, eventually arriving in countries like England, Canada, and the United States as refugees. They arrived with nothing. But they possessed something more valuable than money: a deep, intuitive understanding of Dhandho. So what did the first Patels in America do? They didn't invent a new technology or start a risky venture. They looked around and saw a simple, existing business that was in trouble. In the early 1970s, America was in a deep recession, crippled by an Arab oil embargo. Gas prices were sky high, and people weren't traveling. As a result, small, family-owned motels along the highways were failing. Banks were foreclosing on them, and they were being sold for pennies on the dollar. This was a distressed industry. It was hated, unloved, and full of uncertainty. And that's exactly where the Patels saw their opportunity. Let's imagine a man Mohnish Pabrai calls Papa Patel. He arrives in America with his family and a few $1,000s he managed to smuggle out of Uganda. He sees a 20-room motel for sale at a ridiculously cheap price. He realizes that if he buys it, his family can live in a couple of the rooms, eliminating their biggest expense, rent. He pulls together about $5,000 in cash from his own savings and loans from relatives. The seller and a local bank, eager to get the distressed property off their books, agree to finance the rest. Now, here is where the Dhandho magic happens. The previous owner had to hire staff for the front desk, cleaning, and laundry. Papa Patel fires everyone. He and his wife work the front desk. The kids help clean the rooms after school and on weekends. Their operating costs plummet to near zero. Because his costs are the lowest in town, he can offer the lowest room rates. This drives up his occupancy, and soon, he's making more profit per room than his competitors, who can't possibly match his prices without going broke. The family lives a simple, frugal life. They cook their own meals. They don't take vacations. All the money they make goes into paying down the motel's mortgage at lightning speed. Within a few years, they own the property free and clear. The return on their initial $5,000 investment is astronomical. But what about the risk? What if the business failed? This is the core of the Dhandho philosophy. Papa Patel analyzed the downside, and it was tiny. If the motel failed and the bank foreclosed, what would he lose? His initial $5,000. He had virtually no other assets for the bank to take. His personal guarantee was meaningless. And in that worst-case scenario, he and his wife could still get minimum wage jobs, save up for a couple of years, and try again. The odds of losing everything twice in a row were incredibly small. But the upside? The upside was life-changing. It was a classic coin toss where the odds were stacked in his favor. Heads, I win big. Tails, I don't lose much. This simple formula, repeated over and over by thousands of Patel families, is what led to their domination of the motel industry. They weren't innovators, they were brilliant copycats. The first few Patels figured out the model, and the thousands who followed simply lifted that proven idea and scaled it across the country. Mohnish Pabrai shows us that this wasn't just a historical fluke. He tells the story of Manilal Chaudhary, another Gujarati immigrant who arrived in the U.S. in 1991 with nothing. Manila worked 16-hour days at a gas station, 7 days a week, saving every penny. He and his siblings pooled their money, lived together, and worked tirelessly. For years, he patiently waited for the right opportunity. It came after September 11, 2001. The travel industry was once again in turmoil. Fear and uncertainty were everywhere. Motels were on their knees. Just like Papa Patel, Manilal saw a distressed business in a distressed industry. He found a beautiful Best Western motel for sale at a deeply discounted price of $4.5 million. He and his family had saved $225,000. They cobbled together another $125,000 through home equity loans and partnered with a few friends to make the down payment. He took over the motel, applied the same low-cost Dhandho principles, and just 4 years later, that property was worth over $9 million. His family's initial investment had multiplied nearly 5 times over, not even counting the handsome cash flow the business was generating every year. He made one big bet, at a time of maximum pessimism, when the odds were overwhelmingly in his favor. Heads, I win. Tails, I don't lose much. Now, you might be thinking this is just a strategy for hard-working immigrants from India. But Pabrai brilliantly dispels this notion by taking us to meet a man who couldn't be more different, the flamboyant, life-loving, British billionaire, Sir Richard Branson. Branson may seem like the ultimate risk-taker, but Pabrai reveals that at his core, he is a master of Dhandho. Take the story of Virgin Atlantic Airlines. In 1984, Branson knew nothing about the airline business. He was running a successful record company when someone sent him a business plan to start an airline flying between London and New York. His partners thought he was crazy. "You'll need a 747 jumbo jet," they told him. "Do you have any idea what that costs?" Branson didn't write a fancy business plan or raise millions from venture capitalists. He picked up the phone, called Boeing, and asked if they had an old 747 jumbo jet lying around that they'd be willing to lease to him for just 1 year. Amazingly, Boeing said yes. Branson then realized something beautiful about the airline business model. He would get paid for all the tickets about 20 days before the plane ever took off. But he wouldn't have to pay for fuel until 30 days after the plane landed. His working capital needs were virtually zero. With the favorable lease from Boeing, his total downside risk, the maximum amount he could possibly lose if the airline failed completely, was just $2 million. At the time, his record company was on track to make $12 million that year. He bet a small fraction of his company's earnings on an idea with an enormous upside. He saw a gap in the market, where existing airlines offered terrible service, and he went for it. Heads, I win. Tails, I don't lose much. This became the blueprint for the entire Virgin Empire. Virgin Mobile doesn't own a cell phone network, it uses Sprint's network. Virgin Pulse Electronics sold at Target didn't require Virgin to build factories, they found a Chinese company to manufacture them. In over 200 businesses, the story is the same. Find a way to enter a market with minimal capital and minimal risk. From the Patels to Richard Branson, we see a pattern emerging. But Pabrai takes it to another level with the story of Lakshmi Mittal, one of the richest men on the planet. While Bill Gates built his fortune in the high-margin, high-return software industry, Mittal chose one of the worst industries imaginable: steel. Steel mills are capital-intensive, have unionized workforces, and have no control over the price of their raw materials or their finished product. It's a brutal business where most companies have gone bankrupt. So how did Mittal become the king of steel? Dhandho, of course. He didn't build new, expensive steel mills. He waited for existing ones to fail. He would find state-owned, inefficient, cash-bleeding steel plants in places like Kazakhstan or Romania that were on the verge of collapse. Governments were so desperate that they would practically hand him the keys for free, just to keep the jobs in their communities. Mittal would take over these massive assets, which cost billions to build, for pennies on the dollar. He would then apply his operational expertise, streamline them, and turn them into cash-gushing machines. His entire strategy was built on one of the core tenets of Dhandho: buy distressed businesses in distressed industries. He was buying dollar bills for 10 cents. So, these stories are fascinating, but how can we apply this? Pabrai synthesizes these journeys into what he calls the Dhandho framework, a set of 9 simple, powerful principles. First, focus on buying existing businesses. Startups are incredibly risky. Papa Patel didn't build a new motel, he bought one with a long history he could analyze. In the stock market, this means buying shares of established companies, not gambling on speculative ventures. Second, buy simple businesses. Motels, steel mills, record companies. These are businesses you can understand. Pabrai, like his hero Warren Buffett, believes that change is the enemy of the investor. If you can't explain what a business does in a few simple sentences, you shouldn't invest in it. Third, as we saw with Mittal and the Patels, buy distressed businesses in distressed industries. The best time to buy is when there's blood in the streets, when fear is high, and the future looks uncertain. As Buffett said, be fearful when others are greedy, and greedy when others are fearful. Fourth, buy businesses with a durable competitive advantage, or what Buffett calls a moat. For Papa Patel, his moat was being the absolute lowest cost operator. No one could compete with him on price. For a company like Geico, its moat is its direct-to-consumer model, which gives it a permanent 15% cost advantage over competitors who use agents. A moat protects a business's profits from invaders. Fifth, bet heavily when the odds are overwhelmingly in your favor. Pabrai calls this few bets, big bets, infrequent bets. Most of the time, you do nothing. You wait patiently. But when you find that rare no-brainer opportunity, you don't just dip your toe in, you bet big. He introduces the Kelly formula, a mathematical principle that helps determine how much of your bankroll to bet on a favorable wager. Papa Patel and Warren Buffett may have never used the formula, but they intuitively understood its logic. When you find a mispriced gamble, you go all in. Sixth, fixate on arbitrage. Arbitrage is essentially a risk-free spread. Pabrai uses a wonderful analogy of a barber in a new, growing town. If he's the only barber for 17 miles, that distance is his arbitrage. He can charge a bit more and deliver slightly worse service, and people will still come to him because it's convenient. Eventually, other barbers will show up and that spread will disappear. But for a few years, he can rake in supernormal profits with very little risk. Dhandho is all about finding these temporary arbitrage gaps in the market. Seventh, and this is perhaps the most important principle of all, demand a margin of safety, always. This is the cornerstone of value investing, championed by Benjamin Graham. It simply means buying something for significantly less than what you believe it's worth. If you calculate a business is worth $1 per share, you don't buy it at 90 cents. You wait until Mr. Market, in one of his manic depressive moods, offers it to you for 50 cents. That 50-cent gap is your margin of safety. It's what protects you if you're wrong, and it's what gives you spectacular returns if you're right. The bigger the discount, the lower the risk and the higher the potential return. 8th, invest in low-risk, high-uncertainty businesses. This is a subtle but crucial distinction. Wall Street hates uncertainty. It confuses uncertainty with risk and punishes stocks accordingly. A situation is high risk if there are many possible outcomes, and many of them are negative. A situation is high uncertainty if there are many possible outcomes, but none of them result in a permanent loss of capital. Pabrai gives the example of Stewart Enterprises, a funeral home company he invested in. The company was drowning in debt, and Wall Street priced its stock as if bankruptcy was certain. There was huge uncertainty about how the company would solve its debt problem. But Pabrai realized the underlying business of funeral homes is incredibly stable and predictable. The company owned hundreds of profitable funeral homes. He calculated that even in a worst-case bankruptcy scenario, the hard assets were worth more than the stock price. The risk of losing money was tiny. He made the bet, the company sold some assets to pay down its debt, the uncertainty lifted, and the stock soared. Heads, I win. Tails, I don't lose much. And the 9th and final principle is one of the most freeing: invest in the copycats rather than the innovators. Innovation, Pabrai argues, is a crapshoot. The real money is often made by those who take a proven concept and simply execute it better. McDonald's didn't invent the fast food hamburger. Ray Kroc copied the model from the McDonald brothers and scaled it brilliantly. Microsoft didn't invent the graphical user interface or the spreadsheet. They copied them and bundled them into a dominant operating system. Pabrai even applied this to his own investment fund, shamelessly cloning the fee structure and principles of the original Buffett partnerships. Cloning is for sure, innovation is a gamble. Now, buying is only half the battle. Knowing when to sell is often the harder part. For this, Pabrai introduces us to a tragic hero from the ancient Indian epic, the Mahabharata, the young warrior Abhimanyu. Abhimanyu knew how to enter the enemy's deadly, spiral-shaped battle formation, the Chakravyuh. He had learned the secret from his mother's womb. But as he learned how to get in, his mother fell asleep, and so he never learned how to get out. He entered the battle, fought bravely, but was trapped and ultimately killed. His dilemma is our dilemma as investors. We get excited about buying a stock, about entering the Chakravyuh, but we rarely have a clear exit plan. Pabrai offers a simple, powerful rule to protect us from our own emotional brains: any stock you buy cannot be sold at a loss within 2 to 3 years of buying it. Why? Because businesses go through ups and downs. If you buy a great business at a great price, and then the stock drops 50% because of bad news, our fearful brain screams, "Sell, run." This rule forces you to give the business time for the clouds of uncertainty to clear. Real business change takes time. More often than not, if your initial analysis was correct, the market will eventually recognize the company's true value. Pabrai shows how this rule saved him from a huge loss and turned a failing investment in a steel company, Universal Stainless, into a big winner. After 2 to 3 years, however, the shackles are off. If the investment is still underwater, it's likely you made a mistake in your initial judgment. At that point, you should sell, take the loss, and learn from it. So, how do you put all this into practice without spending your entire life analyzing stocks? Pabrai acknowledges that for most people, buying a low-cost index fund is a perfectly good strategy. But for those willing to do a little more work, there's a better way. He points to Joel Greenblatt's magic formula, a simple algorithm that finds good businesses trading at cheap prices. Pabrai calls this the Dhandho Index. It's a way to automatically fish in a pond full of undervalued companies. You can simply buy a portfolio of 25 to 30 of these stocks and hold them for a year, which will likely trounce the broad market indexes. Or you can use that list as your hunting ground. Instead of searching through thousands of companies, you start with a pre-screened list of a few hundred promising candidates. This brings us to the final lesson from the Mahabharata, the story of Arjuna, Abhimanyu's father and the greatest archer in the world. His teacher, Dronacharya, sets up a test. He places a wooden fish on a pole and asks his students to shoot its eye by looking at its reflection in a pool of water below. He calls the first student forward and asks, "What do you see?" The student replies, "I see the ground, the water, the pole, and the fish." Dronacharya tells him to sit down. He calls another, who says, "I see the water, the pole, and the reflection of the fish." He too is told to sit down. Finally, Arjuna comes forward. Dronacharya asks him, "What do you see?" Arjuna replies, "I see only the center of the eye of the fish." "Fire," says Dronacharya. The arrow hits its mark perfectly. This is the final piece of the Dhandho puzzle. In a world with thousands of investment options and endless noise, the Dhandho investor defines their narrow circle of competence, the simple businesses they truly understand. They ignore everything else. They patiently watch and wait, scanning the radar. And when that one, perfect opportunity appears, that deeply undervalued, simple, distressed business with a durable moat, they shut everything else out. They focus with the single-minded intensity of Arjuna. All they see is the eye of the fish. Commentary. What I find so profoundly beautiful about the Dhandho investor is its simplicity. In a world that constantly tells us that making money is complex, that it requires fancy algorithms, PhDs in finance, and taking on huge risks, Mohnish Pabrai brings us back to a timeless, fundamental truth. Wealth creation is often about doing simple things, patiently, and with a relentless focus on not losing money. The core mantra of the book, heads, I win, tails, I don't lose much, is more than just an investment strategy. It's a way of thinking that can be applied to almost any major decision in life. Before starting a new project, taking a new job, or making a significant commitment, ask yourself, what is the absolute worst-case scenario? Can I live with it? Is it survivable? And what is the potential upside? If the downside is limited and the upside is significant, you found a Dhandho opportunity. This mindset is incredibly liberating because it removes the terror of catastrophic failure. It encourages you to make bets, but smart bets. It reframes risk not as something to be embraced for its own sake, but as something to be intelligently and ruthlessly minimized. The most actionable takeaway for anyone, right now, is to start building your own Dhandho index watch list. You don't have to invest a single dollar yet. Just go to one of the free stock screeners online. Pabrai mentions Joel Greenblatt's Magic Formula website as a great starting point, and pull up a list of companies that are both good high return on capital and cheap low price to earnings ratio. Pick one or two of those companies that are in an industry you find simple and easy to understand. It could be a restaurant chain, a clothing brand, or a furniture store. Then, just start reading. Read their annual report. See what the CEO is saying. In doing this, you're not trying to become a Wall Street guru overnight. You're simply practicing the art of Arjuna, learning to focus on one target at a time. You are building your circle of competence, one simple business at a time. Pabrai ends his book with a powerful reflection that I think is essential to mention. He reminds us that the Dhandho framework is a tool to build wealth, but wealth itself is not the ultimate goal. He shares a story about his friend who, after becoming a successful entrepreneur, dedicated his fortune to helping the poorest of the poor in India. When asked why he does it, his friend simply replied, "Helping you makes me happy." Pabrai urges us to use the wealth we create not just for ourselves, but to leave the world a little better than we found it. And that, perhaps, is the wisest investment of all. That was a summary of the Dhandho Investor by Mohnish Pabrai. We've touched on the core principles today, but I have to be honest with you. A summary is like looking at a photograph of a grand feast. You can see what's on the table, but you can't taste the food. The real magic of this book is in the stories, the details, and the way Pabrai's thinking slowly seeps into your own. This summary is designed to help you decide if this book is worth your time. If the idea of low-risk, high-return investing has sparked your curiosity, if the mantra heads, I win, tails, I don't lose much resonates with you, then I encourage you to grab a copy. Reading it is an experience that could fundamentally change how you think about building wealth. Also, if you found this journey valuable, please take a moment to click that like button and subscribe to the channel. That way, you won't miss our next exploration into another life-changing book from the billionaire's bookshelf. Let's keep learning and growing together.